They do have
yes,
a value of about 1 billion worth of TBs.
Yes, but then when you try to look, I mean, every other bank has got exposure to government in terms of treasury paper.
Yes.
But I think the issue was about individual lending, lending to individuals and obviously companies associated with certain government individuals.
Okay.
So this obviously resulted in non-performing loans, which some believed were understated and therefore didn't give a proper picture in terms of real earnings. So in real terms or realized earnings, the market always believed that CBZ's real earnings should be discounted by a certain factor of upwards of 30. And when you then do a simple PE matrix valuation, you'd realize a price or a value which is definitely below half of what the market is trading at. So I think this is something that the market has obviously now put into effect, that the loan book is coming down. CBZ may be taking care of that historical issue to do with its loan book. In terms of performance, they have slowly been going up, but they are trading updates yesterday. The value of transactions in absolute terms is going up. But then there's been a slowdown in terms of transactions volume, but the absolute volume has been going up. But I think this speaks largely to what is transpiring in the economy.
Yes.
In terms of tightness, in terms of tightness in the monetary policy, as well as aggregate demand.
Okay.
You can no longer afford to spend at the same level which you were spending last year. The exchange rate effect, the inflation effect, and all these factors are obviously militating to push down and constrain consumption, and this is obviously seen through the decline in transactions value from CBZ. But generally, the CBZ touch, which I believe is the future, it has been going up, and when you look at other matrices as well, they are quite in the positive as well.
Okay, I would also like to say bravo to them on that CBZ touch, because they did really jump onto that bandwagon as soon as Stuart really introduced their first.
And the application is phenomenal as well. I think it was one of the fastest growing application in terms of banks applications in Zimbabwe. And obviously they are reaping some good rewards out of it. And them being the largest bank by customer size, they've been able to leverage that best to grow the application. And its usability is obviously growing with it, and so that obviously speaks to a growth in future terms in the non-funded income line.
Yes.
And now that they're taking care of the funded income line, it might actually drive them into something, into a better position generally in terms of their finances. I think obviously Getbacks there going up as well, but in a marginal sense, they obviously another financial institution to watch. They're trying to obviously sort out their listing in terms of in the next few months. They're trying to commercialize their operation from being just a deposit taking microfinance institution. So that's obviously another factor to watch. Over the past week, they mentioned that they raised 5 million in terms of their bond, and that money should be put to should be loaned out to customers at a good rate. Old Mucho coming off, like you mentioned, Padenga as well, and obviously the top 3 counters. So these are basically 5 of the top 10 counters on the stock market, thereby weighing the overall, the top 10. But the pressure now is coming from mid to low tier stocks, and these are stocks that are now obviously feeding into the same momentum that was that was raised by these top counters. Whereas the top counters have now reached a certain ceiling where investors are starting to take off. The broader market is now starting to obviously tap into that momentum which was generated by this top tier stock. So that variance is obviously bringing about sustained pressure in terms of
yes, and I think it really explains the marginal movements for all the indices.
Because it's cutting out losses from the top tier, whereas the broader market, which is not as big in weight, is actually coming
because if I'm not mistaken, these three counters do constitute about 40 to 45% of that market. Econet at 4 billion and both Delta and Cassava at around about 3.5 billion thereabout in terms of market capitalization. Now onto our forex markets. The Old Mutual Implied Rate did strengthen today, coming off from 9% to about 9.68 there. But then that gain in terms of us then calculating our Old Mutual Implied Rate would come off mainly because of how the rand has not been performing very well versus the US dollar. And then we look at our parallel market, has weakened to about 8.2. Some trades were actually going up as high as 8.6, they're about 8.7 some, and then on a continued path. If you can look at the line there, it is almost looking as if it's a very sustained incline there to about 5.65 now. Now, if we are to have a convergency, where do you think the rates would settle at?
I don't seem to have a clear picture in terms of where I think the market will settle. But I think what's fundamental when you're looking at these things, there's obviously an issue to do with perception, to do with how the generality of the economy feels about the government in place, how they trust your policies. And obviously we do not have precedents as a country. We have not done this thing right before. So obviously there's still the suspicion that in as much as we are in the Second Republic, obviously the guys who are running the state are still the same guys who were there before. That's much of the sentiment that's shared. And there's not as many people who are acquiescent with the economic policies, and if you tell them that we are pursuing an austerity policy, it eludes most people to try to deduce what it really means in simple terms, and at what point something might turn out to start to yield good gains. But I think generally the assumption of market forces is something that is really positive, but it also needs to be closely monitored in line with sentiment. Sometimes you let market forces come to play, but you haven't corrected the sentiment. Yes. Although sentiment can correct itself over time due to a shift in market forces, it might immediately bring in that volatility, which sometimes might not be controlled. The fear here is that once prices start to move or run is the way they're doing right now, they might obviously push further government's own expenditure. And when government's own expenditure goes up, in light of the lack of sources of alternative funding, yes, to suit that additional bill of, government's budget, it means government has to find a way to finance that. And the obvious way that might seem unavoidable in that respect is obviously treasury bills. Now, in January, at the end of the year, I did a pure analysis to try to project if government was going to stick to the $8 billion budget. And my analysis was telling me that government could not afford that. And I had already projected that government expenditure would go to 12 billion. But I now feel that that's also a conservative figure, despite that government has said this is what would achieve. And they're now projecting their revenues to go up to about 9 billion thereabout, up from about 6 billion thereabout. So that gives you another variance of almost 3 billion, although the minister says it's about 2 billion thereabout. Now, the danger here is that in 2018, we had a deficit of 2.8 billion. In the year past, we had a deficit of 1.5. And the previous year, 2016, we had about another 1.5. And it is these accumulating deficits which resulted in government resorting to treasury bills to finance these expenditure gaps. Now into 2019, irrespective of the fact that our deficit to GDP ratio, if you look at the impact of inflation on GDP, obviously it inflates in nominal terms. But then when you look at the deficit to GDP level, it really comes down. But then that's not really the worry here. The issue is, how are you going to finance the deficit position, irrespective of where your GDP level is? Of course, the solace, from an international or from an economics perspective, when you're trying to use the GDP to deficit levels, you're trying to say, how much productive capacity do I have to finance my debt? So if your GDP is growing, it means you also have capacity to pay your debt. But this is not the case here. Our productive base is not likely to go up in real terms. In fact, in real terms, it's coming down. So now we need to isolate the impact of GDP growth. We need to just look at the deficit position in isolation. Now what happens? The deficit position, which I project should be between 3 and 4.5 billion, should be funded from treasury bills. And the impact or the pressure on governments on the fiscus is supposed to come in from around May going upwards, which we're already in the second month now. So government would adjust its own civil service wage bill. It would also adjust producer prices, those subsidies. It would also have to adjust its own infrastructure bill, among other peculiarities like the IDAI and all those other course, the drought and so forth. So this will definitely push the bill upwards. And also the danger now of letting market forces come to play at this point, when you do not have an alternative source to suiting your additional bill, is that you will have to respond as much as, in line with the growth in prices. So if prices respond, your own budget will no longer suit you, and you have to resort to addition. So we can't wait to say the market will stabilize in December or January. What will you do now? Now it means you have to find alternatives, and those alternatives are borrowing. And once you borrow, you push up money supply, and once money supply goes up, it pushes inflation as well, and the cycle keeps going on, and that might go out of hand. So we cannot try to find solace in economies such as Egypt, which I think 2 years ago they undertook a similar program of trying to let market forces determine their market rate. But the uniqueness of Egypt is that it had already arranged a funding structure upwards of 2 billion with the IMF, which obviously could fill in the void of having to resort to local alternatives of funding. So if you're using an alternative which is outside your local market, it means you don't push money supply, because you're simply getting money at residual, discretionary rates, and that obviously keeps your money supply in check. And therefore the market was, although it fluctuated, it stabilized within a very short space of time. So obviously I don't have as much a very clear rate to say the market might stabilize. It depends on how government reacts. But obviously government, I don't see it having the ability and the stamina to sustain to contain such a crisis. Because within just a few months, we can feel a very serious pain, and this cannot be sustained. If you look at how, of course, the surplus is being celebrated, but when you really look at how people are suffering, and when you really look at what we are losing in terms of production and so forth, the opportunity cost is quite high. My own view is that the opportunity cost of the austerity is worse off than what we are gaining. What we are losing out is more than what we are gaining. So I think in nominal terms, when you try to just look at the budget in terms of our collections and our expenditure, yes, we are in the positive on a nominal basis, but I don't think that we are able to calculate and compute to see what real value we are actually losing in pursuing that move. I feel that at this point there's much in terms of cost that we have accrued ahead of what we have gained, and that means on the net we are actually in the negative, and I don't seem to support the austerity, the kind of austerity measures that are being pursued.
Well, there you have it. Respect does not support that austerity, and Equity Access does have an economic review and outlook paper that was out for Q1, and Q2 will be scheduled to come out in the first or second week of July. Now, you will get it with an invoice. Don't forget to like, follow, and subscribe our YouTube, Twitter, and Facebook accounts at Equity Access. Good evening.